mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Lock YouTube channel. I'm James Locke. Today we're going to answer some Ask James questions of the day. The first question is from Jerry. He says, I plan to retire soon. How do I know whether to look more to invest for income in the stock market or in the bond market? All right, Jerry. So this is a crucial decision that depends on several key factors. The first thing to consider is your risk tolerance. Ask yourself, how much of a decline in your investment portfolio can you comfortably withstand before it starts to affect you emotionally and financially? This pain point is essential because it will determine the mix of assets that make up your portfolio. Assets that are less likely to drop beyond your tolerance level. Now, traditionally, high dividend stocks have been a popular choice for income seekers in retirement. These stocks offer attractive dividends that can provide a steady income stream. However, they also come with higher volatility compared to bonds. If you have a higher risk tolerance and seek some capital appreciation along with income, high dividend stocks could be a valuable option, especially if you believe the market will continue to perform well or if you're uncertain about a recession. On the other hand, bonds and bond-like instruments are known for their income-generating capabilities with generally lower volatility compared to stocks. So if your primary concern is stability and you need a reliable income stream, then allocating more to bonds might be a better choice. Bonds pay regular interest payments, and if held to maturity, they return the principal amount, making them less susceptible to market fluctuations over time. The decision also hinges on how much income you require in retirement. If high dividend stocks can meet your income needs while aligning with your risk tolerance, they could be suitable. However, if you find that stocks alone don't generate sufficient income, or if you're uncomfortable with their volatility, supplementing with bonds can provide the additional income and security that you seek. Now, additionally, consider your outlook on economic conditions, particularly the actions of the Federal Reserve. If you anticipate economic challenges or a potential recession, you might want to lean more towards bonds, which historically perform better in downturns due to their fixed income nature and relative stability. Ultimately, the best approach is often a balanced one that aligns with your personal financial goals, risk tolerance, or income requirements in retirement, things like that. So diversifying across both stocks and bonds can provide a well-rounded portfolio that balances income generation with risk management. As always, it's crucial to review your portfolio regularly and adjust your strategy as your financial situation and market conditions evolve. Great question. If you want to send in a question, email that question to me, to poollock@poollock.com. And we're going to move on to our second question. This is from Deb. Deb wants to know, don't I still need growth to help offset inflation? Deb, great question. Crucial consideration for anyone planning for retirement. The challenge lies in how you achieve growth while also ensuring a reliable income stream. Traditionally, when people talk about needing growth to offset inflation, they often think about their investments increasing in value. The dilemma with this approach is that it typically involves selling shares to generate future income, which can be risky, especially during market downturns. However, there are strategic ways to pursue growth while prioritizing income. For instance, investing in solid dividend-paying stocks can be effective. Companies with a history of increasing dividends not only provide a steady stream of income, but also offer the potential for that income to grow over time. So this dividend growth can act as a natural hedge against inflation as your income increases along with the dividends paid by these companies. Now, another approach is through bonds and bond-like instruments. These assets generally provide more immediate income than stocks. So if you don't need all the income from the bonds, you can reinvest it using a strategy known as dividend or interest reinvestment, where you purchase more shares or bonds. Over time, this reinvestment can compound your income, effectively helping you keep pace with inflation. So yes, it's crucial to have an inflation hedge in your retirement portfolio. However, rather than relying solely on speculative growth stock strategies, consider implementing one of these kind of more structured approaches. Whether it's through dividend growth in stocks or reinvesting income from bonds, both methods offer a prudent way to grow your income organically over time. Ultimately, the goal is to strike a balance between generating sufficient income and maintaining the potential for growth to combat inflation. This balanced approach not only safeguards your retirement income, but also helps ensure your portfolio can adapt to changing economic conditions. Hey guys, thanks for the awesome questions today. If you want to send in your questions, you can do so by emailing them to poollock@poollock.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I will see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.